I'm very excited to say that Hatem Dhiab from Gerber Kawasaki joins us live now from the west coast of America. Hey Hatem, thank you so much for joining the Pulse this afternoon.
Hey Danielle, so good to be here.
Yeah, no, this is really exciting. This is a first for Ausbiz. So, lots going on at Disney. Bob Iger is back at the helm. The streaming wars are continuing to go on. Why did the market not, well, seemingly at this point in time, not like these results?
Yeah, you're right. Bob Iger is back. This is his second quarter back at Disney after a really tumultuous few years under Bob Chapek. But what happened is Disney is still losing money on its streaming business. So I think the market is really looking right now at all the streamers and trying to understand who's going to start making money on the actual DTC business. And Disney is losing less money, but still losing. They lost about $500 million. And I think the market wasn't very excited about that.
Yeah, so how are they going to redress this? How are they going to, oh, well, we could apply it to all the streamers, couldn't we? Because they're all struggling to monetize this product.
Yeah.
What's the strategy for Disney to try and monetize it?
Well, there is a big shift that's been happening in Hollywood over the last 5 years with the streaming kind of coming front and center, and their traditional businesses. So their regular cable business is losing subscribers, losing advertisers, but now they had to spend all this money in the streaming business, and you add the fact that the economy is really slowing down and advertising revenues are going down. You have kind of a double whammy. I think what Disney is doing is reducing their headcount. They've announced a bunch of layoffs, just like everyone else here in the tech and media business. They're also spending less money on content, which is also something that is hurting Hollywood in general. So between those two things, and hopefully over the next few quarters, we'll see those losses basically disappear.
Yeah, and maybe in terms of average revenue per user, they've expanded into India with Hotstar. Is that a drag on the business as well at the moment?
Yeah, it is right now. The RPUs from India are lower or are going down. Obviously, India is a much bigger market, and Hotstar is actually has millions and tens of millions of subscribers. But the average revenue per user there is much lower than the US. But what Disney is doing there is really they're trying to kind of build more market share and really get more subscribers. And even though they will make less money per user, the reality is there is, 1.5 billion people in India. And as you know, the Disney brand, the Disney content is really something that no matter where you live, you can connect to it.
Yeah, absolutely. Let's talk about the bright spots in the results, because obviously lockdowns were absolutely horrendous for the likes of Disney. No one could go to the parks, no one could take the cruises. So how are those divisions performing at the moment?
I don't know how it is in Australia, but in the States, there is something called revenge travel, and everyone is traveling. We're seeing it everywhere, and I think the parks are a big benefactor of that. The visitors are up, the number of visitor ups, the spend per user or per visitor is up. Also, Disney is doing well in China. China was locked down. They have a park in Shanghai that was locked down for years now, and finally opening up. And I think the Chinese also are coming out in droves. So as a result, we're seeing that business really take off too. And this is really what's cool about Disney, and that's why we like the company here is, they're not just a streamer, they're the only business that have the parks and all the products and the commercialization for their products that they can generate tremendous amount of revenue.
Yeah. Cool. Can you explain to the viewers, so they've acquired 33% of Hulu that Comcast had owned. Australian viewers probably aren't really across, I mean, they know Disney, of course, and they know Star Wars and they know the parks, but what is Hulu and what's the significance of it, as well as the significance financially in terms of the debt component rising for the company?
Yeah. Absolutely. No, I don't think Hulu is in Australia, so that makes sense. So Hulu is basically is another streamer, but it's more kind of an adult or professional streaming. So they have your traditional TV shows. They have a bunch of cable, traditionally cable networks. So not just your traditional Disney content, but other content that may appeal to adults and people that are not just looking for family content. And what happened a few years ago, this was a joint venture between Comcast, Disney, and Time Warner. And what happened? It was kind of almost adversary to Netflix. But what happened is Disney bought 66%, but also did not buy the rest from Comcast, and they had put a price on it at $28 billion. They had valued the business already 3 years ago, and Disney is supposed to buy the remainder for $9 billion in next quarter. And what happened over the last few months is, as Bob Iger came back, we didn't know if Disney was going to go through with this buying the rest of Hulu or not. And today we got some answers. Basically today, Bob Iger said they're going to go ahead and they will acquire the remainder of Hulu for $9 billion over the next year or so.
And I guess the big question is at this point in time, when it's sub $100, and of course this isn't investment advice, everybody has to do their own homework, but from Gerber Kawasaki's perspective, is this company looking like good value below $100?
Yeah, as you said, it's not investment advice, but we do like Disney, and we think it's such a well-rounded brand. I think they've gone through this transition from your traditional media to a streamer very, very well. They've seen kind of the writing on the wall about 4 or 5 years ago, and they started this Disney Plus, and they have over 100 million users now. So I think they really are in their way to becoming a major player in the streaming world, and their other businesses, the cruises, the parks, the movies too. If you think about the box office and people going back to theaters, will also do really well. So I think it's a very, very well run company. It is run by one of the best executives in Hollywood.
Indeed, but I guess it also begs the question, and it's not directly comparable, but a lot of investors look to Netflix as well as an option to invest in, and Netflix has sort of turned the corner over the last few months, certainly in terms of the share price performance. Do you have a preference between the two, or is it a case of, to quote one of them off CNBC, not would you rather, but you can have both in the portfolio?
Yeah, and we do own both. It's kind of two different businesses. Netflix is more of a pure play streamer that has a global reach. We're talking about Netflix having 250 million subscribers across the world. Disney is kind of a more diversified. It's a media company that does movies, that has sports, that has obviously the parks as we discussed. So I think it's two different businesses that you can own. Netflix may be a little bit more growth than Disney, but I think they're both very, very great businesses.